Good day and welcome to Phillip Roundtable. Today we will delve into a critical question that holds significant relevance in today's dynamic global landscape. As the world grapples with unprecedented challenges and uncertainties, it is imperative to critically analyze the economic resilience of the Asian region, a powerhouse that has consistently exhibited strength and adaptability throughout history. In today's session, we will discuss the economy of Asia for a better planning of our investment. So let me introduce our distinguished panel of experts. Our first panelist, Mr. Tan Chi Xiong, is the Director of Intermediary and Private Retirement Business from AHM Capital, formerly known as Affin Hwang AM. Mr. Tan joined the partnership business team of AHM Asset Management Berhad as a Senior Associate Director for the Insti Unit Trust Advisors in January 2020. His current designation sees him actively involved in driving business development as well as managing relationships with the various distributors and business partners of the firm. Prior to his current role, he was the head of retail business of AHM Capital, where he was pivotal in driving the growth of the personal wealth business team as well as the expansion of the firm's retail business segment since 2010. He graduated with a Bachelor of Arts degree in Business Administration from University of Aberdeen, Dundee, United Kingdom, and is also a certified financial planner. Before joining AHM Capital, he began his career in consumer financial services within the banking sector. Our second panelist, Mr. Wu Mantai, who will join us in 10 minutes' time, is the head of investment services with Principal Asset Management since June 2018. Previously, he was with M Private Banking as the head of investment management and products. Mr. Wu brings in with nearly 30 years of experience in the financial industry. Since 2000, he has served as a portfolio manager for both international and domestic equities. Prior to that, he was an investment analyst, having worked with a few global investment banks. Our final panelist, Kim Cho, is currently an investment specialist at Phillip Capital Malaysia. He has over 5 years of experience in the financial industry, mainly in the stockbroking, equity capital market, and investment banking fields, with stints at MIDF, Amanah Investment Bank Berhad, and CAF Equities Sdn Berhad. He has serviced institutional clients and foreign funds by providing macro research, trading ideas, market commentary, and analysis for Malaysian equities in his previous role as a stockbroker. Kim holds a first-class honours in accounting and finance from University of Warwick, United Kingdom. So, let us just start with questions on overall view of the Asia Pac. So, the International Monetary Fund predicts that Asia Pac gross domestic product GDP to expand 4.6% in 2023 after growing 3.8% in 2022, mainly led by growth in China and India. Kim, could you shed some light on what's driving the growth in Asia?
Okay, thank you to the host. Basically, the main development has been the reopening of China, where surging consumption is expected to boost growth across the region, despite weaker than expected demand from the rest of the world. But of course, along the way, when China announced their reopening in the month of January, towards now May, we are seeing some mixed numbers in terms of for example, their property sales, spending per capita, or even the government has been withdrawing COVID-related stimulus support in China, coupled with high youth employment rate. So investors are probably not as optimistic as beginning of the year due to the so-called lack of stimulus support from the government per se. But the good news is if we compare to the pre-COVID level, broadly, China has already recovered to pre-COVID level. And to recall, IMF revised upwards their projection in Asia, which is 4.6% in 2023, higher than 0.3% than the October projection, is mainly because of China reopening. And if we look at the GDP growth itself, right, IMF is expecting China to grow at 5.2% in 2023 and India to grow by 5.9%. And in terms of the global growth, Asia is expected to contribute around 67% of global growth in Asia. China around 31%, India around 17%, less than 20%. And in addition, if we look at China, if we look at Asia itself, it has less intense inflation fight compared to the developed economies. And also, even if we look at the recent chaos, the banking chaos in the US and Europe, Asian financial system hasn't seen major impacts following that. We think that China 5% GDP target should be attainable, even though the recovery route has been very bumpy. And PBOC also guided that it will maintain ample of liquidity in China in order to stabilize growth and as well as jobs and focus on the demand. So all this will actually bode well for the recovery in China. And meanwhile, just now we mentioned about India. India has been foreign investors' favorite since beginning of the year with net foreign inflows year to date. Foreign investors have been buying India because of their strong macroeconomic fundamentals, and the government has been heavily invest in public infra in order to fuel future growth. And the consumption has been very solid because of their large, young, and rising share of middle class income population. So all this will actually bode well for the prospect of Asia in 2023.
You mentioned about inflation in Asia is not so pronounced, but
Yes.
specifically in China, the recent inflation data is just 0.1, 0.2%, and that figure might be too low for a developing country like China. What's your view on this?
Okay. If we look at the inflation number in China has been relatively low, even after they announced a reopening has been relatively low if we compare to the developed economies. But of course, inflation is actually a function of employment as well as economic growth. As well as we continue to see, we have yet to see some stimulus from the government per se. But as long as we can continue to monitor that kind of steady growth, that should actually work well for China's recovery.
Okay, thank you. And here comes the second questions. According to S&P Global, about 70% of global oil demand growth will be coming from Asia this year. Many analysts expect a much tighter oil market in the second half, citing a lot more that rests on China's story. On the other hand, we have rising EVs and renewables that dampen the demand for oil and gas. How do you view this dynamic, Mr. Tan?
Hi, good afternoon, everyone. Thank you for having me. On the oil or the energy sector, I think if you look at overall in terms of the top consumption sectors for oil and gas, particularly towards the transportation and as well as the industrial. And transportation, that will include on the airlines and flights as well. And but as we all know that today the oil price is up to around 76 US dollar per barrel. And if you to look at pre-pandemic period, somewhere in 2019, it is somewhere around 60 US dollar on average per barrel before COVID pandemic. And essentially my point is that today the average oil prices is increasing. And with that also we have seen less international transportation, which means the international flight. Even if you look at the flight data on the overall Chinese people, they are still very far away from pre-pandemic. Many of the Chinese travelers today, they are still traveling within the domestic Chinese provinces and not really back to the pre-pandemic period. It's still far away. And those are some of the key pointers that showing that in terms of the oil prices and oil consumption for this year from China, it is really very largely dependent on the for the Chinese tourists to travel out and for a resumption or the normalization of the economic activities in China, which is important. And just a few hours ago, we see the PMI number again below the expansion of the 50. I think it comes out somewhere around 48 something. And with that, we need to see a more meaningful recovery in terms of the economic activities in China. And of course, from US as well. Today, we are still seeing a weak demand in terms of the consumer goods. And that is largely because of the high interest rate that has lowered down the the consumption power of the overall American. And the other sectors that I mentioned just now, besides the transportation, is also industrial. And so what we are looking at is for the oil price, for the for oil demand to come back to a more meaningful level. Therefore, besides transportation, in terms of the consumer demand, which is drive industrialization, is also important. With that, the last point is that the policy that undertaken by the Chinese regulator has to be more meaningful, has to be more direct in regaining the confidence from the foreign investors. Because today, as what we know, is that the foreign investor sentiment towards the Chinese regulator is still pretty weak at this point of time. Yeah.
Mr. Tan, understanding that oil and gas market might be good this year, but then there is also rising EVs and renewables. So how do you think that will impact the oil and gas raw material prices in the coming futures?
For moving future, I mean, there will be a really long term. We're talking about probably 5-10 years, and more EV adoption, especially in China and developed countries to start first. And on the emerging market, it could take some time because due to the infrastructure and the government policies. And that will definitely will start to impact in terms of the energy demand globally. But for now, because of some of the key issues on the climate change, we have seen the extreme weather, right? Certain part of the world is we have facing a heat wave. In Malaysia, we are facing a heat wave. And in certain part of the China and European and developed countries, we are seeing the extreme cold weather. And that trigger a higher demand on the energy, which for heat wave that we're facing, most people are consuming the aircon. For the area that having the extreme cold weather, they are consuming more heater. So that is what I think we already seen last year, especially in the Europe and yeah.
Okay, thank you, Mr. Tan. Hi, Mr. Wu, welcome. We have one question. The following question will be dedicated to you.
Afternoon.
Yeah, good afternoon. So the news flow on the debt ceiling deal have crowded investors over the past 1 month. Would you like to share with the audience on the latest development and how should investors navigate along this volatility? I think the volatility has been there and is subsiding. How do you think this debt ceiling, would impact Asia market if there is?
Right. Before all this, all these noises were there, I was already asked what I think and how they would reach a consensus on the debt ceiling. So at that time, my thinking was, one, it is most likely the debt ceiling will be extended for at least 2 years, or they have a flexible one whereby it will be at least for 2 years. Why I want to say that? Because going forward for the next 24 months, US is going into nomination for US presidential candidate. Then you have the presidential elections campaign. And I don't think the candidates would want to have to handle such an issue as they discussed. And it will become quite damaging if they don't do it properly and debate on it properly for themselves. So the best, and I don't know whether you can call it sensible thing, but the easiest thing to do is to postpone the next debt ceiling discussion 2 years down the road, which I think this is what they are doing. I think the immediate impact is people say, okay. When the next impact is they need to issue a lot of government treasuries. Then the question is, US Treasury yield will peak, will jump up again. That will have an impact. And then post this, then it becomes a question of economics, right? You look at how US first quarter GDP number came out at 1.1, which missed the consensus of 1.9 by a lot. So a lot of people are already expecting when will they have a negative GDP number. Some people say fourth quarter of this year. Some people expect third quarter, and some even dare to say it's the next quarter. I can't tell. But I think what is important is they need to settle all of this first. When the poor GDP number comes out, then the question will then focus on what would be the policy response. For me, this is a cyclical or a slowdown created by the aggressive interest rate hikes. So effectively, the best way to reverse it is how do you reverse interest rate? But they are now faced with very sticky inflation issues. Even though it's now reaching by middle of the year, high base effect, it could drop below 4. But then that is a year-on-year base effect, so you cannot trust that. So it becomes looking at the month-on-month increase in inflation, whether headline or core. So that becomes the next policy focus once this budget debt ceiling is over. So you talk about volatility, the next one is to look out for how market will take the bad GDP numbers, whether it's from US or from Europe. That's how I look at it. I think the issuance of treasuries by US is accepted fact. You'll be there. You'll see what's the eventual number that they will raise. But I guess it'll be quite a bit because I understand looking at the statement from Yellen, they don't have much left in the bank anyway. So they need to not only replenish, but sufficient for the next 2 years. So that's quite a bit of a sizable fundraising exercise to be done by the US now. That's it. Thanks.
A little bit soft from your side. Can you speak louder or adjust your mic a little bit?
Now better?
Yeah, it's better.
Oh, okay, because the angle is wrong.
Okay, great. Okay. Now we talk a little bit on China. So after Beijing lifted the long-awaited COVID-19 controls, spending and restaurant travel have surged. All looked so well, and the Chinese stock market reacted very positively. When everyone thinks that the worst is over, recent economic data shows that the recovery is not as smooth as anticipated. There's a decline in the Chinese stock market. Would you be able to share something on the economy in China, Mr. Tan?
Okay, on China, especially on the recovery in the big tech, what we have seen is that the foreign investors and also the domestic Chinese tech firms, they are still skeptical on the sincerity of the Chinese regulator in supporting the growth of the internet and the big tech sectors moving forward. And the reason is because even today, though we see the message that's been sent out by the regulator is that they're looking at supporting the economic growth, the big tech sectors, the easing of the regulatory crackdown. And on the other side, we're still seeing there are some measurements when it comes into the picture on monitoring and as well as controlling the data sharing between the big tech firms in a more skeptical way. And that causes some of the key concerns from the foreign investor as well as the big tech firm by themselves. And the other things that we think is really important for the Chinese regulator is to continue to encourage on the IPO listing from the Hong Kong or ADR listing, just as a pre-pandemic period, as we have seen more and more fundraising activities within the Chinese domestic as well as the overseas. That is really important to see that activity comes into a more meaningful way. And the other one reason is that it's also very important for the Chinese regulator not to monitor the way the big tech is running their business and the business expansion hold too tight. When you are too tight monitoring the way they are running their business, and it will discourage the innovation, right? And therefore that's very important. And the other thing to talk about the Chinese big tech, especially those listed in Hong Kong, because those are the ones that more sensitive of their share prices towards the geopolitics of China and US. And both parties need to speak to each other, basically to mend the relationship. And as today, as we spoke, the US and China, the trade relationship continue to rise. They are continue to dependent on each other when it comes to the import and export. And even up to today, right, up to 2023 and last year 2022, year on year, we continue to see the increase in terms of the trade on the export and import. And with that, it shows that both world largest first and second economy continue to highly dependent on each other. And with that, we think that for Chinese regulator, they have to do more in order to regain back the foreign investor confidence into the market. And what the Chinese regulator is trying to do now is to encourage or use their SOE, the state-owned enterprise, to drive more in terms of the economic growth and on the infrastructure as well. Yeah.
To extend question further down, given all this tech crackdown, property crackdown, and intensified political tension and whatnot, how do you view the prospect of China in the second half? Can we still expect, probably not just second half in 2024, 2025, and the following years, can we still expect 6 to 8% GDP growth as it was before? Yep,
Okay.
Mr. Han.
All right. Just to make sure that the question directed to me. Okay. We think the target range within 5 to 8%. I think just now Ms. Kim did mention that it's definitely achievable because many of these are highly dependent on the Chinese regulator today. How they are going to run the policy to encourage the growth, right? And so those are my take for Chinese economy for this year. And the other thing I thought is also important to highlight is that the view is that second half of the year we do see a window of improvement of the geopolitics between the US and China. The reason is because with today's situation that hasn't been very friendly among the US and China, we think that for US, we are looking at next year, 2024 presidential election. And we know that for the US nominated presidency candidate, for them to be re-elected, right, even for President Biden today, he needs to make sure the economy and the growth will be in the good shape in order for him to be able to re-elected, to have a higher chance for the election moving forward. And China is their largest trading partner as well, and they cannot go one side. Therefore, we think that second half of the year there will be a good chance for the improvement of the geopolitics relationship between the two parts of the country. Yeah.
Kim, what do you think about the China growth story?
Yeah, all right, okay. Basically, if we look at the numbers right now, yes, we also we are also of the view with Mr. Tan that the recovery has been uneven. We have yet to see, more meaningful kind of growth. Or even if we look at the recent PMI data, right, those so-called weak economic data will actually necessitate the Chinese government to increase their policy actions moving forward. But the comparison must be very fair. If we compare the current numbers compared to the COVID level, right, the recovery has been broadly back to the pre-COVID level. Even if we look at the recent Labor Day data, right, the tourist arrival as well as the tourist receipts have basically exceeded the 2019 level. But of course, the per capita spending has yet to return to the pre-COVID level, but we see some upside there. Hence, we think the comparison must be very fair. A lot of analysts, economists in town have been putting a very, very high expectation on China's recovery and the growth story per se. But do know that everything will still be back to targets. As we mentioned in the beginning of presentation, the 5% GDP target should be very, very attainable. But of course, in order to restore the confidence, right, more work needs to be done. Yeah. And also even if we were to add on the property industry, right, if we look at the property sales in the month of May, the sales numbers have also been very, very disappointing. So we actually expect more and more policies to revive the investments in the property sector moving forward.
Okay, thank you. And then savings from Chinese citizens has been increasing, meaning that they are more reluctant to spend. So how do you view this scenario, Mr. Wu? Mr. Wu, we cannot hear you.
Sorry, can you repeat the question?
Yep,
The sound dropped off a little bit.
Yeah, we are seeing savings from these Chinese citizens have been increasing, meaning that probably they are more reluctant to spend. So how do you view this issue?
Okay, let me put it this way. I know last 3 years, the amount that they save and have double or triple the statistics that they used to do, let's say last 5, 6, 7 years. But you have to accept the fact that last 3 years, given their aggressive lockdown, there's hardly any chance to spend money. You don't go anywhere. Of course, you can say you can go online and spend, but there's only that much you can go online to spend. The 50th pair of pants or 50th blouse that you can buy. So there is a natural increase in savings. But for me, what is more important for the Chinese consumers is they need to regain the confidence level. They may have the savings, but do they have the confidence to spend? You think of it this way, last 3 years, because of the aggressive lockdown, the economy hardly grew. And what it means is last 3 years, all the new graduates, whether it's diploma, university, or those after Form 5 or equivalent to 6th Form came out, most of them didn't find a job. And I'm sure it's already well publicized that China, they're talking about almost 20% unemployment among the youth. And when you have 3 years of, let's say, assume that every year there's something like 7 million young people coming out looking for a job. So for 3 years, 2020, 21, 22, there are 21 million young people floating around with hardly a job. And they will be consuming. That means they are taking up savings, which is most likely their own or their parents. And the lack of savings here, lack of jobs here will be bad for the economy. There's no momentum of growth. The cycle of spending is not there. Confidence level is not there. And then your property sector is not doing well. Secondary prices is also bad. And there are statistics that people tell you that 70 to 80% of a normal household wealth is in the property that they stay in. And if that is the case, even though during the last 3 years, both husband and wife may still have a job, but definitely when 80% of wealth is perceived to be in trouble, then you also have no confidence to spend. So I'm not too discouraged by some people say, the May 1st data is not as strong as it should be. It's only back to 2019 level. It should be higher. But you need to give people more grounds and the foundation to build on for them to spend money. One will be job creation, right? So you need a lot more. That's why you need the economic reopening. And the other implication which I now mentioned is the fact that in China, before 2020, the lockdown, China used to have, it was estimated, the poor is about 560 million people, 40% of the population. The rough estimate now, after the last 3 years, is more than 50% of the population is considered poor. It happens across the whole world, but China is relatively higher. And that again is another negative point against how dynamic, how fast the economy can grow if you don't reopen. So for me, at this point, the Chinese government needs to put in place policies to rebuild confidence. And confidence is a black box sometimes. It may improve because, maybe property sector come back better, or the stock market come back better, or there's better job employment. So it may be a combination of a number of factors that we talk about. And this is what you mean a long-term, medium-term homework that the Chinese government need to achieve for the next 3 to 5 years or even longer. Because every year there's already another 7 million or so fresh people coming out to look for a job. So last 3 years, there's 21. This year, another 7 million. That means talking about a population of Malaysia floating around looking for a job. So you have that thing as well. And meanwhile, the Chinese economic structure have changed. It says, the number came out, manufacturing PMI is bad, services also came off a little bit, but still high. That was not a data that is entirely surprising, because in April, the NPC says that we are reopening, we have growth, but it's not to the level that we like. Then the PMI number came out. So they actually told us the truth. And for me, the way the manufacturing PMI behaves is a function of two things. One, the manufacturing sector faces issue from, one, demand for exports is poor. That means new orders is bad. Two, the manufacturing sector, after being one of the most efficient manufacturing sector in the world, has reached a stage whereby they are no longer that competitive, at least part of it. All right. And at the same time, the manufacturing sector in China is no longer the larger part of the GDP. Back in year 2000, manufacturing is about 40%. Now it's about 30. While services or non-manufacturing, which used to be about 31% of the GDP back in 2000, is now nearer to 50,000. So structurally, there is already a change in what drives the Chinese economy. And what it means is you need different policies to strengthen your services, also to strengthen your manufacturing, and to restructure your manufacturing. This is a very, very long-term development structure, all right? And for me, I think the Chinese government, next 5 to 10 years, they'll be too busy trying to figure out how to rescue themselves, create opportunities for themselves, rather than worry too much about the international politics that they're facing now. Of course, they will need to handle those issues. But the internal issues that they now face is more critical to them than the external issue that the way the developed countries have, the media in developed countries have placed China to be. That's how I look at it. Thanks.
China has increasingly leaning to services rather than manufacturing. So does that mean if we are to take advantage of the manufacturing activity, increasing manufacturing activity in Asia, we should look the other way around, probably in other countries like India or Vietnam?
Well, if you look at how Apple is coming out in the news, that as if the way they are supposed to put more and more capacity in India.
Yeah.
A lot of multinationals around the world will be like, okay, I'm not going to reduce my capacity in China because they still have relative competency and competitiveness to produce whatever I need. But all my additional new capacity that I need, or the newer products, I may want to place it in India and ASEAN. And you look at last year, where the whole world was so volatile, people underweight China like crazy. And the money that they've underweighted China flows to two regions that is still in Asia, but removed from China to some extent, removed from China in terms of their volatility. So you see the outperformance of India and ASEAN. So that is, and to some extent, you continue to see some of that. ASEAN continue to perform this year, and India too. So you do see part of that trend, and I think the FDI trend flow to India and ASEAN will continue to strengthen. And not to mention the fact that even some of the Chinese entrepreneurs themselves will need to move some of the capacity or have additional capacity outside of China Because they may just be normal businesses. They do business with US and Europe, all the stuff. But because of all these noises, they will need to go to another place whereby they escape all these noises, whereby ASEAN and India will be a natural port of call for them. And this is where I believe you talk about the fact that Asia is still one of the best destinations for investment. I totally agree. But what is happening does not make China not investable. But what it means is going forward, you need to appraise the risk that you are taking that by investing in China. Because given the latest development, what has happened, I believe, the risk premium that you attach to China has increased. A higher risk premium means a higher discount rate. Higher discount rate would mean two things: greater volatility and lower valuation. And that also does not make China not investable. But what it means is when you do invest, you just need to make sure that in your overall portfolio, what do you have that can defend your overall NAV against that type of volatility? Either you have more of bonds or more of India or more of ASEAN or other things, or you just figuratively say, okay, previously I always have 25% of my portfolio in China. You just say, okay, I'm not going to have 25% anymore. I go down to 15. But when I think the China market drop enough, is attractive, I will go back to 25. So the tactical element possibly the tactical element of investing in China may become larger compared to previously. That's how one may look at it as well. Thanks.
Mr. Tan, just now early on you have mentioned that talk about something on the big tech in China. So we take a little bit deeper into specifically on AI and semicon. What about the race, of this AI and semicon self-dependency of China? Should we be optimistic on this industry?
Definitely yes. Because of one of the key policy by the Chinese regulator, the dual circulation, they call it. Dual circulation meaning to say that to adopt a lesser dependency on the foreign economy while increasing the domestic consumption and to enhance the domestic capability when coming to the producing the higher technology cutting edge sectors. And I think we have seen those things happening somewhere earlier on this year when there is this particular so-called ban by the Chinese regulator into the Micron, one of the US microchip players. And subsequently, if you look at certain domestic Chinese microchip players, their share prices also have been benefited over that period of time. And even not just the domestic Chinese semicon players, but also we have seen certain Korean semicon players and memory DRAM manufacturers also have been benefited because in China, it's not just one or two key semicon manufacturers like Micron, companies like Samsung Electronics, SK Hynix, they all do have their memory DRAM plants in China as well. And we think that for China to further strengthen and focus into their own domestic semicon or AI capability, yes, there is a huge potential, and in fact, they need to do so. And that's the way that go for their cutting edge technology. And the other part is, I guess, because over the past few weeks, there's a lot of headlines coming through talking about AI, right? And I think even AI in China, certain big tech firms, they do play an important role, and they do have the capability to build and enhance the AI capabilities in China. And with that, it is relatively important for the US regulator to continue to encourage and to have a more flexible framework for the growth of some of the Chinese big tech firms in developing their AI capabilities.
Kim, there have been the risk and diversification of supply chains away from China amid intensified geopolitical tension. Do you think China will not enjoy explosive growth as it enjoyed before COVID-19?
Okay. If you look at the supply chain away from China, that's a reason why actually China is now working very, very hard to achieve self-sufficiency so that it would no longer rely so much on the West. If we look at just to add up what Mr. Tan has said on the semicon industry, right? For now, China semicon industry actually lack the US in terms of patents, as well as South Korea and Taiwan in terms of fabrication. And that is actually quite an alarming sign for China because ultimately because of the ongoing tensions as well as geopolitical tensions, the relationship with the West has deteriorate, and that will actually impact on the supplies moving forward. And do note that given the recent development in the AI itself, China has yet to be able to access to the high-end chips, and that will actually be having some impact on China itself. And we also know that AI also needs some smaller nanometer chips, right, which can support higher processing speed. And given China capability now, they can only mass produce 14 nanometers, but not the smaller ones. So ultimately the self-sufficiency is very, very important. If we look at China has actually made this Made in China 2025 objective, targeting around 70% domestic production. And after years of state investment into those industry, we have started to see some favorable results. We think 2023 is a transition year in terms of that. And if you look at the diversification from supply chain away from China, they have been doing quite a good job in terms of that, especially if you look at the food production in food or grains, especially China has been doing a good job, which helped to insulate their economy from potential sanctions as well as interruption in their supply chain. And also in tech sector, apart from the self-sufficiency aim that I mentioned just now, China is also working on like more than 1 trillion yuan of support package in order to support their semicon industry. So as long as China is working towards that direction in the longer term, China will still be doing fine. But outside China, ASEAN, like what Mr. Wu has said, ASEAN or even India has been a key beneficiary of trade diversion. And that's the reason that is attributed by our strong supply chain, global distribution network, as well as a sizable workforce with low labor costs. If you take Malaysia as example, right, MNC opted to relocate their operations to Malaysia because of our high degree of trade openness as well as low tax environment. And the sectors that benefited the most are actually tech and E&E in Malaysia.
Okay, now we move on to India. I think this is quite a strange market to most of us, and especially our audience. So despite criticism on India's culture, its economy has done spectacularly well, and the Nifty 50 is near all-time high. Do you think India should be another country that investors should focus on, Mr. Wu?
India, a lot of people initially think that it could be the next India, China. I think the possibility is there, but with Indian features. In terms of population, both is about the same. In terms of education level, there's a lot of difference, not to mention income difference. And to some extent, there's also a major cultural divide among its people, which China do not have, in terms of how they perceive various class of people. That, unfortunately, to me, is something very important that the Indian, I would say, they need to overcome, right? But nevertheless, I think the potential is there. India have also a lot of big corporates, huge amount of supply of educated people, also a lot of cheap labor available as well. So I think it is a matter of how the multinationals go in to work with that, whatever India has to offer. I remember reading a couple of months ago when Apple talked about it. They say they need to talk to India and discuss about their human rights and education policy and something like that. I think that is something easier said than done. All right. It may take a generation or two before anything substantial can actually happen. But in between, India would not be like China 30 years ago, whereby you are starting from ground zero. You have nothing. To some extent, India may be 2 or 3 steps from what China was 30 years ago. They already have a base. They already have certain very huge established industries. You already reached that. Used to have that. One of the world's richest men used to be from India as well for a while. But it's a country whereby the disparity in terms of wealth and other things is so great that it could be a deterrent to the smooth growth of the economy. That is something that India will have to figure out for itself. In terms of intellectual property, ability to do other things, is all there. All right. If I want to say there's a difference, because China was and still a centrally planned economy, a lot of their research and some of their progress that they make in terms of their E&E until now is very much government-driven and push. And within India, you do not see such a concerted things. And R&D, unfortunately, you need some coordination. You are not like in the developed countries whereby that practice, that culture has been around for a long, long time. And it's actually very profitable, even at the university level, to encourage all of this. And then it can be commercialized. And India is also very far off from that. All right, they do have some of their staff. Some of the farmers, the big farmer is very, very big, very efficient. But you talk about real homegrown Indian technology, you can't count a lot. All right, that's the reality. Unlike China, you can still count certain names within the Chinese technology or non-technology part of the economy, whereby it's homegrown stuff. So there is that plus and minus within India, but it is now a country with an education system, generally workable government, and they are willing to accept FDIs. All right, and in such an aspect, I think money and entrepreneurs will naturally go over there to look at it and see how viable it is for them and how acceptable it is for them. All right. They are not lacking in terms of the comparable to receiving FDIs. I mean, when Malaysia or in Penang back in the 70s, Georgetown started having the E&E industries, India is also in that game already. But of course, they have other issues, which is not well publicized. It is a country. I used to go there 3 times a year in the 90s, because I used to cover the banks there with a group of people. They have certain type of society and cultural divide, which makes them difficult to take the next step forward. That is my biggest thinking. I'll stop my presentation here first. Thanks.
Thank you, Mr. Wu. While China, Europe and the US has become hubs for the purchase of EVs, India currently lags behind pretty much, and change could be just around the corner. However, with the IEA noting that battery electric vehicle sales in India hit almost 50,000 in 2022, 4 times greater than the previous year, do you think India will be the next rising country to anchor electric vehicles after China, Kim?
I think at this juncture, whether it will overtake China is really difficult to tell because China remains the world's largest EV market, and China, if not mistaken, accounted for around 59% of global sales last year. And China is also one of the biggest EV producer accounting for around 64% of global volume. So if you look at India, right, India, I think in terms of production, we still need to rely on China on the raw material, mineral processing, as well as the most important part, the battery production. And according to some research, right, 70% of the parts used to manufacture EV in India, right, are actually imported from China and a few other countries. I think it's also too risky and expensive for India to be dependent on imports. And at least at the higher ends of the supply chain, they need to invest more, much more from the government perspective. Even from the policy side, there are so much things that the government can work on in terms of subsidies, public procurement, even infra charging station, as well as the stability of the electricity supply is something that the government need to work on. And outside production, if we look at the consumption per se, yes, we agree that India has been a rising star in Asia and global space with their young, very vibrant, large population. And in fact, their population have already surpassed China just recently. So, and if you look at the age demographic, right, 30 over percent, about if you look at the age demographic itself, the average age of the population is around 30 years, 40 years kind of demographic. So as long as we can continue to see that kind of, if you look at the age profile itself, 30 to 40 years old is the most productive kind of labor in terms of the labor productivity. So as long as that can continue to drive the economic growth in India, that will actually bode well with the consumption, coupled with the rising middle class that we mentioned earlier.
Thank you, Kim. And just now, Mr. Wu has mentioned about something on regarding India. So I have one question that can extend from there. So India education has a heavy emphasis on technology sector, and has become a must-go place if you are to get capable workers in the tech space at a more affordable price. Say we are seeing many of the companies, the world-renowned companies, they have their CEOs who are Indian, like Microsoft, what else? Google, Adobe, and even IBM. So, Mr. Wu, do you see this as a trend that will continue, so that there will be some spillover effect to India?
Yeah, education is definitely skewed towards the technical side. Paramedics, engineering, and the like. That one is definitely true. That's why you have last time the Bangalore, a long time ago, the IT software, and China and India used to have some of the largest software consultants around, listed ones as well. All that. But software, unfortunately, is and coding, unfortunately, is a bit of a commodity. And the value add do not last. All right. So for me, I think, how will I put it? They would need a little bit more substantial in terms of their own capability in other type of the technology industry. Like Japan some people is precision. All right, we can talk about that. China have something, Korea have something, and Taiwan have something. So which part of that spectrum is India in? They have, at this point, there's no clear foothold. I will put it that way. All right. But I'm sure if they have a little bit more effort or policies to drive in that direction, I'm sure it's something that they can achieve over the next 10, 20 years.
Mr. Tan, we have one question for you. The India's power generation grew at a fastest pace in over 3 decades in a year ended March 2023. Reuters analysis of government data show that it is fueled by a record rise in output from both coal-fired and renewable plants. Will the power demand in India stay robust for the time being, or has it hit a bottleneck?
I think there will be more room to grow. There are a few reasons. One is, as I think just now during the session, we have discussed about certain key manufacturers, global manufacturers are looking to relocate or probably to diversify some of their operation or manufacturing hub in India, right? So that will continue to provide the boost to the demand on the energy. And the other thing is India, as we know that they are still undergoing a rapid urbanization, right? So that is interesting. If you look at overall the population, it's about 40% for those that below 25 years old. And that is a huge potential for the economy moving forward. And with the younger people, most of the time, we tend to see the urbanization, people are moving to the city center. And that will spark the further usage and the demand on the energy because of the demand on the housing, property, and the growing, the development on the other part of the foreign direct investment that's setting up their manufacturing plant for opportunity for these young people who are coming to the city center. So that with that we see ongoing the demand on the energy. And the other thing I think just now earlier part of the session also did mention the climate change, right? The extreme heat and the cold weather that will again continue to drive the demand on the energy as well, with more people turning into the aircon when we see the extreme heat weather around. So we think the last part is on the urbanization. That's one thing. The other one will be on the growing industrialization and the manufacturing in India moving forward. That will contribute to energy demand moving forward.
That's all for India. Now we're back to Malaysia. The latest quarter appeared to reveal a potential downside risk to earnings as companies reported results that either met or fell short of expectations. There's just a couple of stocks that outperformed and that above the expectations. So with only a few beating consensus, is Malaysia market likely to stay challenging this year? Kim, what do you think?
Okay, if we look at the latest quarter, right, most companies are actually impacted mainly by rising electricity costs as well as labor costs. And to recall, last year we just started to increase the electricity tariff, and most of the companies are being hit this year. And the labor cost is because of the minimum wage. The implementation was from May 2022 last year, but the full impact on the companies per se will be in 2023. So we believe the market is likely to stay challenging in first half of 2023 due to some earnings risk from rising costs. But we expect a sustained market recovery in second half driven by improving earnings outlook, because this year we don't see any prosperity tax, we don't see any cukai makmur this year, as well as we also don't expect any other negative taxes being implemented by government. Also ahead of state elections in July, probably August. We don't foresee the current unity government to implement any negative policy changes. So the earnings outlook on the corporates in second half is expected to improve. And there's also some other factors that is going to drive the Malaysian market, including low foreign holding as well as relative political stability post the state elections. And we also think that Malaysia fundamentals remain strong on firm domestic consumption as well as resilient external trade activities. And also on the positive side, given our strong diplomatic relationship with China, China's economic recovery is raising our prospects for improving bilateral trade as well as returning Chinese tourists. If we look at the sectors, tech, of course, if we look at the recent quarterly results, tech sectors are among the peers that actually didn't meet much of the consensus numbers. But we believe mega trend of the tech is here to stay for multi-years. The industry has actually corrected for almost 2 years to digest the excess inventory as a result of the unprecedented COVID-19. And now we see China has already reopened and recovery is on the way. So I think tech is something that we should look at. And also, if we look at the most of the local tech companies, right, they are in the midst of expanding their production in 2023. So we are only expecting the so-called earnings, right, to kick in next year in 2024. And because usually market is priced based on forward expectations, so I think we should sooner or later roll over our valuation base year to next year.
So KLCI has been quite great, and what are the catalysts available so that we can expect a better prospect in Malaysia, especially the KLCI? Yeah, Mr. Tan.
Okay, for the catalyst in Malaysia is that, okay, first of all, I think just happens that this morning I'm doing a Malaysia outlook. So just echo back this morning. If you look at the top sector contributor for KLCI overall year to date, we have seen the energy, construction, as well as property. Those will be the few biggest contributor for KLCI year to date. And those the lagging will be on the financial, even the consumers, and as we can see, those are the rotation that we have seen the contributor for last year, and this year they are not doing so well for year to date. However, having said so, I would like to also echo on what Kim is talking about. Today, Malaysia's largest trading partner is China. With the China reopening, once we see the momentum taking into place, that should encourage further momentum for the Chinese, for the Malaysia sectors as well. And few sectors like industrialization, because if you look at China reopening, with the normalization of their economic activities, Malaysia and as well as Japan, actually we are one of the key exporter on machinery to China. And Malaysia should be benefited from that perspective when we see a more meaningful recovery in terms of the economic activities and demand from the Chinese from Chinese consumer. And the other thing is also with the reopening of China, with more activities ongoing, the higher demand on commodities like oil, that should also benefit Malaysia as the oil producer country. So the last point is that let's recap on the valuation part. I think across the Asian peers, Malaysia KLCI valuation, the price earning is somewhere around 13 times. If we compare with the average Asia peers, it's somewhere around 15. So we are considered excessive if compared with the Asian peers. Yeah.
Extend the question a little bit. Any sectors that you are currently bullish on?
For now, what we are looking at is the more defensive sectors like healthcare. And at the same time, we are also cautiously bullish on the financial, as we are still expecting the foreign direct investment continue to coming into the country once a better sentiment coming through from the China. And both financial and healthcare is one of it. So those are the areas that we are more positive on for now.
Technology sector, and we know technology sector in Malaysia has been down for over a year, and recently there's of course some stocks you can see some bottoming range there. So can we expect a better prospect for technology other than healthcare and financial?
For Malaysia technology, second half, we need to observe. The reason is if you look at the market pricing activities, like year to date, you look at US NASDAQ, the tech index, that has went to bull market twice, right? Over 20% run. And as we know that how the share market works is that the market will always price in advance, probably 2 to 6 months in ahead. And with today's market macro environment, we have seen the pricing activities of the market has even gone beyond 6 or 9 months ahead. And with the NASDAQ has been leading the contributor on the tech side. And with that, we see those also serve as a lagging indicator, as a spillover effect on the recovery on the tech index performance into Asia, probably by second half or early next year. Yeah.
Okay, thank you, Mr. Tan. Mr. Wu, there's been some positive news on FDI lately. For example, Malaysia secured investment commitments of 170 billion from China from the visit last month. How would this benefit us? Mr. Wu, yeah.
Those are proposed. Effectively, what's the percentage of actual implementation, we can't tell. But even, let's say we stretch it over a period of 3 years, we can achieve more than 60% or even near to 70% implementation. I think it's already very good. And this is just China alone. Please do not forget the rest of the world, which has been here in Malaysia for many, many years. And do not forget what you see in Batu Kawan, the new Silicon Valley that is happening. And what you see in Batu Kawan is a E&E that is many, many times more sophisticated than what you saw in Penang in the 70s, 80s, and 90s. Totally different type of companies, different type of value proposition. So to some extent, we would, of course, like to have a bit of everything. But I think the world going forward, if we have been having a bit of so-called ahead of everybody in terms of the E&E side, then we have to ask ourselves in terms of E&E, what type of value-added products do we want to capture and which part of the supply chain do we are in, and how do we build that supply chain to attract the people to come? I think that is very, very important. For me, for example, you take example, this is something I think of and think of it this way, right? Let's say at the end of year 2022, total global E&E sales is 100 trillion. And 15 years from now, it could be 350 trillion. So that's 3.5 times more. But in that run up to 15 years from now, different products, either new or existing, will have a different growth path. So the question to ask ourselves is, which of these products and which growth path do we want to add on? And to attract and to get into that type of growth path, who and what we must do to achieve that. Like who means our FDI policy. How do we go and market straight to those group of guys to come here? And how do we be ready for them? So this is, I think, where if you want to talk about anything beyond the next 2 years or 3 years, you talk about the fact that it is very likely for the next 10 years, the amount of FDI that will flow to Malaysia is easily 20 to 30% more than what it was the last 15, 20 years. Then you ask yourself, we just cannot be, say, like, we take anything. I think that's not possible. Because one, we have a small population, our education base is different. All right. So we have to be, to some extent, selective, yet, able to something whereby the country as a whole can benefit. I think this is a thinking process and planning process, which I think the government needs to talk to the E&E boys, because all of them talk directly to the multinationals who knows exactly, like now people talk about AI chips and all that stuff, right? So are we positioned to capture part of the AI chips growth? And is it going to be one of the highest value added chain? And if we are in a position to be able to capture that, how can we strengthen that and convince them to come? I think that is the more important part in terms of, I think, the growth strategy that Malaysia have to do. Whether those boys are from China or from Brazil, from UK, really doesn't matter. It's a matter of what can we do to get them to come here. And after that, how do we, I will call it ring fence, how do we get them to stay? For example, after the 90s, I think a lot of the low-cost manufacturers just moved out of China. There was a major hollowing out. But that doesn't mean that no people continue to come in. But there was a change in the composition of the manufacturing sector in Malaysia. And it's not what it is now, right? So we have to plan for the next stage. Of course, it may not work out the way we want. But if we do not have a roadmap in hand, I think that's where I think that is even more troubling. That's how I put it this way. I think the government fully realized that. If not, they're not going to China and attract all those money. And I think Malaysia is a destination which the Chinese entrepreneurs like. They have similar culture and all that stuff. Accessibility is easy, all right? ASEAN, you can fly from Malaysia to almost the rest of the world, the rest of Asia. So I think we do have the advantage. So we need to strengthen those and improve on the weakness. Thanks.
So you have mentioned about some AI and E&E in Malaysia. So what about data center? Because I heard a lot of news talking about new data center in Malaysia. Was talking about billions and billions of ringgit. What do you think about this?
Data center, to some extent, is an extension of cloud, or is part of cloud. To some extent, Malaysia, in terms of hard infrastructure, I think we are very good. Whether it's power supply, water supply, we are all there. Like, example, you go to Thailand, I'm not saying anything bad about Thailand, but they look slightly different. Every industrial estate, the large one, will have their own water supplier and their electricity supplier. All right? They do not have a equivalent of the Naga to do everything for them. All right? So in this place, Malaysia have an advantage. All right? So this is things whereby I think we can do that. And why not? It's just one part of the supply chain solution that Malaysia wants to offer to the world. We can be here. That's the reality. All right. Although I think it may include certain type of adjustment to telecommunication strategies and policies and submarine cables and things that comes to Malaysia. I think, if I remember correctly, Malaysia seems to have some issue with submarine cable. Nobody want to be onshore in Malaysia because of high cost or something like that. So these are issues that Malaysia government needs to work it out from the ground up. You want this? How do you get them here? What do they need? And can we do that? It's just, if it's a cost of onshoring in Malaysia, what is there? Nothing wrong. Just give it to them. That's how I look at it. All right. I'm not expert of policy making, but this is a hypothetical way of thinking. Thanks.
Tim, as we know the KLCI components, majority of them are financials, plantations, and probably some oil and gas, and some gaming stocks like Genting Malaysia and all this. So I think it's too reliant on commodities and some stable stocks like financials. So if you're talking about growth, what's the route ahead for Malaysia if you want to see the index rising?
Okay, I think what Weiler said has been very right. Our KLCI are the top 30 stocks that have been very heavily reliant on the traditional economy. So as well as the defensive sectors like the utilities and whatnot. So those are very, very stable companies. Moving forward, I think the catalyst of Malaysian market is, of course, our politics and economics. The fundamentals remain very strong. But I think over the longer time period, we need to see some so-called reshuffle in terms of the index components. Even recently, we see Inari has emerged as become one of the components in the KLCI index. But of course, now the market cap has dropped below rank 36. It is now no longer the index component. But what I'm trying to say is that everything is possible, and we all know that among the tech names, right, the growth in the tech sector has been very resilient. Even before, even during COVID time, we are able to see some form of double-digit kind of growth, earnings growth in the tech sector. This is something that we need to have moving forward. But the catalyst for this year, if we don't talk about the so-called reshuffling of the index component, just looking at the top 30 stocks that we have alone, right? Just looking at the top 30 stocks we have, if you look at the earnings growth this year, will be around 10% in the absence of prosperity tax. So the earnings growth will be there. But moving forward, I think what drives the earnings growth will be for example, some form of cost optimization, sometimes some form of revenue top line growth. This is something that we need to look at. And outside KLCI, I think there are pockets of opportunities in even tech sectors, the smaller caps, the middle caps. There are pockets of opportunity there. So I think investors should not only be focusing on the broader KLCI, but rather on the broader market. For example, the quality middle cap or even the smaller cap names in the Malaysian market.
For our questions, but before we end, probably our audience would like to know a wrap and our stance, to Asia Pac region. So probably Mr. Tan, would you like to start first to give a stance on this region, just a short one?
Okay, a short one. We continue to expect Asia to be benefited when the sentiment from the Chinese economy gradually improves, and that should have a positive spillover effect into overall Asia. And as well, the other part of the spillover effect is from the US, as we are heading towards a higher interest rate environment in US. And with that, we think the market will always looking at pricing in very fast, 6 to 9 months probably in ahead. And with that, one thing to note is that in 2023, our view is that it will be better than 2022. So that is the verdict of overall Asian economy for this year. And by next year, 2024, we should be able to see, or maybe by end of 2023, by second half of this year, we should be able to see a gradual improvement on the sentiment, because in US, they need to ramp up their economic growth to prepare themselves for the US presidential election by next year. Yeah, that's all for me.
Mr. Wu, what about you? Any advice for our audience on Asia Pac?
Asia is still one of the most diversified regions. We have high growth region, which is Northern Korea, Taiwan, and China to some extent. Then you have a little bit more of those lower brick and mortar but safe names, which is in ASEAN. All right, so I think Asia will always be able to attract capital. So the question now is in terms of valuations and your earnings growth. I think generally after the reopening since last year, Asia's profit performance has generally been acceptable. Malaysia falls short, right? I'm not sure. But for me, there's generally a lot more things that one can do in Asia, right? So there are different countries, different value. Even recently, Vietnam has attracted a lot of attention, even though it's still a very small market, to some extent illiquid. But there are now renewed interest in that as well. and partly because of the FDI flows, which I'm sure Vietnam stands to benefit as well. Because last 15 years, Vietnam has been one of the largest recipients of FDIs and has made Vietnam into one of the fastest growing economy in the world, together with India. I think they average 7 to 8% last 10 years or so. So that tells you a lot. And this is how I also say that there are also other countries that if they can go on a similar path, there'll be other countries that can emerge as the next Vietnam or something like that. That will take over the next 5 to 10 years. I think this is something that the diversity and the ability to provide a new growth element becomes something that Asia has always been able to provide to global investors.
Kim, what about you? Any last advice?
Okay, I think what Mr. Tan and Mr. Wu said, echoing what they said, I think there are pockets of opportunity in Asia. Even if you look at the valuation itself, compared to our regional peers, Asia, like for example, MSCI Asia Pacific Exchange is now trading around 13 over times. Even Malaysia is around 30 times, and Hong Kong, China is below 10 times. So the valuation has been very, very attractive and inexpensive. Even if you look at the earnings yield itself, Nasdaq, the earnings yield is around 3.8%, but the US government bond yield for 3 months is around 5.3%, 1 year is 4.8%, 3 years is around 3.6%. So there has been some negative risk premium there, which cannot justify some form of rich valuation in the US market. If you look at Malaysia, our earnings yield is around 7.6%. The 3-month bond yield is 2.94%. So we are pretty much attractive. Even if you look at China, the earnings yield is around 8.5%. Hong Kong is 10.6%. So all this will actually support the valuation in Asia region.
For today, thanks again, Mr. Tan, Mr. Wu, and Kim, for your valuable insights. So remember to stay informed and proactive in your approach to managing your finances and investment. By implementing the strategies and tactics and also, we discussed today, you can position yourself to weather the storm and emerge stronger. Thank you for joining us, and we wish you all the best in navigating through these challenging times. Last but not least, stay invested. Thank you.
Thank you so much.
Thank you, everyone.